You just learned about the basic attributes of a corporation, the most significant one being that a corporation is a separate entity from its owners. When dealing with a corporation, you will treat them as their own taxpayer and analyze the facts to determine the tax consequences of transactions between it and other parties, including its owners. Usually the first thing that comes to a student's mind when talking about shareholders is the stock market. If you want to own stock, that's the place people usually go in order to own a company. Those transactions are between shareholders and don't involve the underlying corporation. When an investor buys shares in Walmart, that doesn't impact Walmart at all. Walmart has a new shareholder now, but economically Walmart isn't impacted. The transactions between a corporation and its shareholders are when the corporation issues. Before we discuss these transactions, it's helpful to review how realized gain is calculated. Any gain or loss realized is recognized unless another section of the code provides an exception to the general rule. The first step in any transaction is to calculate the realized gain and determine if a section of the code provides an exception from recognizing the gain. To calculate realized gain, you need to calculate the amount realized and the adjusted basis of the property. If the amount realized is greater than the adjusted basis, then you have a realized gain, and if it's less, you have a realized loss. Let's first look at a scenario between two different individual taxpayers to calculate their realized gain. When a corporation is formed, its owners need to contribute capital to help get the business started. The capital contributed could be in the form of cash, property, and/or services. When a company files an IPO, they are normally looking for cash contributions. However, cash isn't the only asset that can be contributed. An important question you'll need to answer for your clients is, how are property contributions treated for tax purposes? This job aid was created with the goal of helping you understand the requirements of Section 351. In the upper left-hand section, you'll see the three requirements of an AND test. For a transaction to qualify under Section 351 and defer all of the gain or loss associated with the asset contribution, it needs to meet the following hurdles as laid out in the code. 1. Receive solely stock in exchange for the contributed assets. Keep in mind that relief of debt is considered receiving something other than stock as part of the transaction. 2. Shareholders who contribute assets need to collectively own 80% or more of the vote and number of shares immediately after the contribution. And 3. The shareholders are contributing property to the corporation and not services. To help you remember these three requirements, we've created the mnemonic SOAP, S-O-A-P. S, solely stock. The shareholder can only receive stock in the transaction. O for ownership. The contributing shareholders have to own 80% or more of the vote and number of the shares. A for and P for property. Property has to be contributed. We'll explore each step in more detail later. The words clean and dirty used in this job aid are not tax terms like boot, which you'll learn about later. They are used to help with the acronym. To have a clean transaction, the shareholders need to meet all of the Section 351 requirements. If they do, then all of the gain or loss realized is deferred, and their stock basis is calculated per this formula. If a shareholder doesn't meet all of those requirements, then we'll call it dirty. This doesn't mean they lose all of the benefits of Section 351. We'll explore this section of the job aid in future sections. The important thing to understand now is the requirements of Section 351. Now that you have a basic understanding of the rule, let's understand the reason why the government provided this tax benefit to corporate owners. Sean is going to contribute land, which has a basis of $10,000, to a corporation, and he will be the only owner. He gives the corporation his land in exchange for stock worth $50,000. Sean has given this land to a separate entity and received more in value than his basis in the land. Should he realize and recognize gain as a result of the transaction? Remember that all realized gain is recognized unless there's a special exception in the code. Did he really give it to someone else? Technically, he did give it to a separate entity, a corporation, but he owns 100% of this entity, so he really just moved the land from one pocket to another. He owns the land before and after the transaction. It's just held in a different form. The government tries to minimize the impact tax has on business formations. As a result, it included Section 351 into the Internal Revenue Code, which allows for the deferral of gains and losses on certain contributions to a corporation in exchange for stock. This is a scenario where the realized gain is not recognized, but deferred until a recognition event, like a stock sale, occurs.